You retire. You start to collect your pension. Life is great. Then, out of the blue, your former employer calls with an offer to return to work. You think to yourself, this is awesome. I'm going to collect my pension and I'm going to work on top of it. This is very commonly known as double dipping. But are you making a critical mistake? Not only are we going to tackle the very common question, can I work while receiving a pension? But we will go through the numbers and you will want to watch to the end as we uncover one of the most expensive tax mistakes Canadians can make while double dipping and strategies to avoid it. Let's jump in. Today, we're going to dive into a topic that doesn't nearly get enough attention, but it's critical for anyone who's thinking about working after they retire and start collecting their pension. We'll explain what double dipping means when it comes to retirement, whether it's even possible for you, and the potential tax liabilities if you're not careful. We'll go through some examples with some actual numbers so that you can see the differences in tax rates, and we'll share a strategy that can help minimize this liability if you find yourself paying too much in taxes. That said, before implementing any of the strategies discussed today, it's critical to emphasize the importance of consulting with investment and accounting professionals. Double checking with your portfolio manager, investment advisor, and your accountant is generally best as they can give you the proper advice tailored to your specific financial situation. So before implementing any of these strategies, be sure to seek professional advice to maximize the benefits of your retirement planning. So what does double dip mean in retirement? Well, double dipping is loosely defined as the practice of simultaneously receiving income from multiple sources such as a pension or retirement savings alongside earnings from part-time or full-time employment or consulting work. This approach lets you benefit from having money come in from different places at once, but it's important to think about how it affects your taxes and what you're entitled to. Is double dipping even allowed? Well, I think for the most part it is, but whether you can double dip in retirement depends on a few things. It's all about your pension or retirement plan rules and the laws where you live. Sometimes you can work and get a pension at the same time, but in other cases there might be rules against it. For example, the Canadian government allows you to work while collecting the government pensions of CPP and OAS benefits, and the BC's teacher's pension plan doesn't seem to have any issues with it. However, it's a very different story for the Saskatchewan Teachers Federation, where at a special meeting of council held in October 2022, a resolution was passed to change the plan's reemployment rules so that effective July 1st, 2023, any STRP pensioner who is reemployed as a Leads member or an STF staff member will have their monthly pension suspended and will be re-enrolled in the plan for their entire period of reemployment. In short, double dipping or working while collecting a pension is often allowed, but it's really crucial to confirm with your pension administrators and employers first. Rules can vary, so it's best to check directly to ensure that you're on the right track. Now let's assume that you are allowed to double dip and you want to return to your employer. Let's take a look at what can happen tax-wise if you aren't careful by examining some numbers. And for this particular example, we're going to keep it very simple by focusing on a single person. Once you're married, things can generally get a little bit more complicated because you can income split your pensions and retirement income with your spouse. To avoid all that complexity, we're going to just stick with a simple apples to apples comparison involving a single individual. This way we can give you the clear and straightforward numbers you need without getting bogged down in the more complex aspects of tax strategies that come with marriage. Okay, so let's assume that you're 65 years old and you're collecting the maximum old age security of $8,560 and the maximum Canada pension plan benefits of $16,375. On top of that, you've got a pension paying you $65,000 annually, nearly matching your pre-retirement income. With a total income of $89,935, you're financially secure, but there is no margin for error as you have no other investment savings you can draw from. So when your employer calls and asks you to come back to work, the prospect of earning extra income alongside your pension benefits is really enticing. Let's crunch the numbers using an online tax calculator, focusing on Manitoba as your place of residence. When you earn $89,935 annually, your average tax rate stands at 24.3%, while your marginal tax rate hits 33.25%. 5%. After factoring in both provincial and federal taxes, which total $21,854, you're left with $68,081 in hand after taxes. Now let's assume that you went back to work full-time and earned an additional $80,000 on top of the $89,935 you are already getting from your pensions, bringing your income to $169,935. What you need to know now is that your income is above the OAS threshold. The next year, your OAS will completely be clawed back, losing $8,560. But let's assume for this example, to make things simple, it's next year already, and we take that amount off so we can see the impact. When you earn $169,935 annually, your OAS will eventually be clawed back, taking you down to $161,375. Your average tax rate now jumps to 31.72%, while your marginal tax rate, the tax rate on your next dollar of earnings, hits 43.40%. After factoring in both provincial and federal taxes, which total now $51,192, you're left with $110,183 in hand after taxes. What's intriguing to observe is that while your income didn't quite double, factoring in the OAS clawback, it only increased by 1.79 times your original amount. Your taxes, though, more than doubled, rising by 2.34 times, a considerable jump. As a result, your after-tax income only saw a 38.2% increase despite almost doubling your gross income. These numbers show that working in retirement without proper planning might not be worth it. Even if your income almost doubles, the effects of higher tax brackets and clawbacks can eat into your earnings significantly. So while the idea of earning extra money might sound appealing, it's really crucial to consider how it will affect your overall finances. That said, for many, their job isn't just about the work, it's about the people and the company that they work for. Some really love their jobs and want to keep working even in retirement because they genuinely enjoy what they do and they like their employers. They enjoy the camaraderie and sense of purpose that comes with their work, and they want to stay productive. However, they also don't want to see a huge chunk of their earnings being eaten up by taxes. So the question remains, could there be a better way? How can we help avoid significant taxes when collecting pensions and working in retirement? Well, the strategy I often suggest is to open up a corporation. And I do this work with the close collaboration of an accountant to help ensure that the numbers will work for the client. So why open up a corporation? Well, a corporation is like its own person. It's separate from the individuals who own it. So when the money comes into the corporation, it's not considered personal income for the people behind the business. Instead, the corporation handles its own financial affairs, like having its own bank accounts, credit cards, and other transactions that are held separate from you as the person who might control the corporation. So now let's look at the exact same numbers, but this time, instead of taking it personally, you open up a corporation as a consultant, and the income is now not being paid to you personally, but it's being paid into the corporation. Your income from your pensions now remains unchanged. You earn $89,935 personally, your average tax rate stays the same at 24.30%, and your marginal tax rate is the same at 33.25%. After factoring in both federal and provincial taxes, which total $21,854, it's the same amount. You're left with $68,081 in hand after taxes personally. Now, what's changed is instead of your employer hiring you on personally, they hire you on as a consultant. And here's an important thing to note. Your employer has to agree to pay your corporation for the work you do as a consultant. Unlike regular employees who get paid through payroll and that income is paid personally, consultants work on a contract basis. So you'll need to talk to your employer and ask them to pay your corporation for the services that you provide. This often means negotiating the terms of your contract, like what you'll be paid and what work you'll do. But in short, you do not want to be hired on as an employee and paid personally. You want the money to be paid into your corporation. Once that arrangement is taken care of, let's assume that the $80,000 you're now earning now gets paid into your corporation. Well, here's what happens. When your other source of income is paid into your corporation instead of to you personally, the corporation is the one that gets taxed. Generally, corporations enjoy more favorable tax rates for active business income. It's critical, however, that your income would be considered active rather than passive. Active income, money earned through actively providing goods or services, is taxed at a much lower rate than passive income, which includes earnings from investments, rental properties, or royalties not related to active work. This distinction can significantly impact the amount of taxes you owe, so it's essential to ensure that your income is considered active to benefit from the lower tax rates available to corporations. So what is the combined federal and provincial tax rate for active income in a corporation in Manitoba? 9%.
Did you say 9%?
Yep, 9%. So let's break it down. The $80,000 you now earn as a consultant and paid into your corporation is taxed at a rate of just 9%, which comes out to just $7,200. And since you're not taking this income personally, your old age security benefits remain unaffected by clawbacks. Overall, your tax liability only increases $7,200 plus the previous $21,854, totaling $29,054, an increase of just 33% more in tax. And as a result, you keep personally or you control through your corporation the initial $68,081 plus the now $72,800 left over from your consultant earnings. This totals $140,881 combined. Imagine doing this for 4 or 5 years after retirement. Just think about how much it could build up in your corporation. But there are a few more important things to consider. When you eventually withdraw the money from your corporation, you'll need to pay some tax. However, it's likely it'll be at a reduced rate compared to the personal tax rates. Plus, you now have the flexibility to control how much you withdraw personally from the corporation, making it even more tax efficient over your lifetime. Now, there are some cons to opening up a corporation. It's worth noting that accounting costs for corporations aren't exactly cheap. So you're going to have to factor in these additional expenses versus the tax savings that you're going to receive. On the bright side, having the money build up in your new corporation opens up all kinds of options, especially if you don't need all of the money. With estate planning, for example, you can explore utilizing insurance to preserve your net worth with your corporation. Here's the bottom line. While the idea of working in retirement to boost income might seem appealing, it's essential to consider all of the potential tax consequences. Without proper planning, additional earnings could lead to significant tax liabilities, reducing your overall income. However, there are strategies like incorporating a business that can help minimize taxes. Consulting with your portfolio manager, investment advisor, and accountant is key to finding the right approach for your situation. So while working in retirement can be fulfilling, it's critical to proceed thoughtfully and consider the financial implications carefully. Did you know that navigating the uncertainties of the markets and your finances is generally smoother with the guidance of an investment advisor or portfolio manager? Studies have consistently shown that individuals who work with an investment advisor or portfolio manager tend to accumulate a net worth up to 3 times higher on average compared to those that go it alone. But that's not all. There's a significant impact on overall well-being, with those who seek professional advice exhibiting higher levels of happiness and lower anxiety. Do you want to know an easy way of identifying what kind of plan you have at work? Or maybe you want to find out more about my latest upload? Well, I've got everything all queued up and ready for you. Click here for more amazing financial insights. I'll be waiting. We'll see you soon.